could show you how to be trading it, because right now we kind of have a little bit of a line in the sand. This market has taken a little bit of a sideways turn. And if you're listening to what CNBC said this morning, they're arguing that, well, it's happening because the AI trade is cooling off. That's not is what no, that's not what's happening. This isn't that hard. I don't get it. I don't understand why it's so difficult for these people to understand this. Maybe they don't want to have to explain it, or maybe they just will never be able to interview anybody at the Federal Reserve ever again if they actually explain how any of this works. Okay, there's our little guy printing the money. We had another $20 billion yesterday in the repo market from the Federal Reserve. Don't call it quantitative easing, call it financial market stabilization, whatever it is, doesn't matter. End goal is the same: to stabilize the financial system. That's it. It's the goal. It's the backdoor mandate if you must. But we will talk about momentum. We're going to do the runner. And then I'm going to focus today, based on the fact that we are on the verge of negative red momentum on the daily. We're going to talk about different ways to trade this, and the 5 stocks that you really should be keeping an eye on, the charts you need to be watching, and the scalping and positioning that you can be utilizing in the next 2 to 3 days. If this breaks down, it's going to break down relatively quickly. If it holds on, if the Fed intervenes, the market will just go right back to all-time highs, because that's how the market works. They admitted it in the last couple of months. All right, you're joining us today because, well, you're seeing a lot of weakness in different places today, and I need to tell you whether or not this is real or not. So you see this movement down. You see NVIDIA down 2% on the day. You see all the stocks on the Dow Jones getting beaten up the way that they are. 7 or 8 stocks sitting here that are down more than 1%, which doesn't sound significant, but when a lot of equities on the same exact index are down 1%, it's not just one thing. They can't say it's the AI trade when Caterpillar is down the way it is. They can't say it's the AI trade when you get the point. Anyway, we're going to dive into this real quick. We'll talk about the major stories of the market, and then we'll spend the last 10 minutes on trading those 5 key names that are going to be the focus of my day today. All right. So we take the number of stocks on the S&P 500, we go out on a bell curve, and we put all of their performances in the last week and the last month in a multi-dimensional analysis, multi-discriminant analysis, and it gives us a number. The number of stocks in breakout territory versus breakdown territory on the S&P 500 is minus 40, which isn't good, but it is a reminder that this market can and will go up despite the fact that the number of stocks that are breaking down. This is last Wednesday. This is the worst breadth for an up day ever for the S&P 500. On a scale of stocks up and down on the day, there were net 298 stocks negative on the day, which means that there were 100 stocks up on the day and minus 398 down on the day. Do the math. And yet the market was still up. So it's just a small number of equities that have been pulling this market higher. You can have 75 guesses, but you only need one to really realize who it has been that's been dragging this market higher. And it's your magnificent 7 stocks. It's the NVIDIAs, the Apples, the Amazons, Teslas of the world. And now we are looking at pressure building on those names. In periods of stress, what we see is a crowded trade, a herd trade, because, again, these stocks are heavily backed by exchange-traded funds and mutual funds, passive investment flows. Basically, these are the most heavily owned stocks in the S&P 500 and really equities anywhere in the world. And they're bought by active managers who are trying to track their benchmark, meaning they're trying to track the S&P 500, which means they're buying the same stocks that have the same weight in the S&P 500, which is NVIDIA up around 7 to 8%, Apple around 7 to 8%. It creates this herd mentality. It is a safety trade. It sounds crazy because there's lots of leverage in this system. It sounds crazy because everybody's doing the same thing. That's how that works. The herd trade works. until it doesn't. And it didn't in February and March. So right now we're starting to see the pressure start to build on the Mag 7 stocks. They're going to change the narrative. They're going to say, well, this is really about the fact that the AI trade is slowing down. No, it's about the fact that the leverage in the system is under pressure. That's what matters. The repo actions by the Fed are to prevent destabilization in the plumbing and a race to cash, meaning that everybody unwinds their bond positions, their stock positions to try to raise cash. That's what leads to dramatic sell-offs. That's what leads to a August 1st through 5th, 2024, when the Nikkei fell, had its worst week since 1987, or early April, where the S&P 500 collapsed, or COVID, where we had a monstrous move down. The bulk of the move down didn't happen over the 33% didn't happen over a period of 30 days. It really constrains itself to 5 or 6 trading sessions. That's what you got to pay attention to. The S&P 500 and the NASDAQ, broader momentum. The daily momentum chart reading, about to go negative. Has flashed negative yesterday for about half an hour. Stock market bounced back. And once again, we're going to talk about this at 9:10. Reversions. This is all about algorithms stepping in and buying on weakness because they're not watching the headlines. And a lot of them are not focused on whether or not things are leveraged to the tilt. They will shut off under the 50-day moving average or under the 20-day moving average. They will shut off at where they're programmed to shut off. For now, they're going to buy because they see that a price is trading at a daily extreme. They will bid it up. Shorts will cover. It will create an environment where the S&P 500 will fall 6 points and then rebound 7 and then sell off another 5. Volatility and average true range are not measured in the fact that the S&P 500 just falls 15 points in a day. You have to start looking at the round tripping and the amount of moves up and down and up and down and up and down along the way. That's what kills the day trader who isn't prepared. That's what makes the market maker who is selling the options a lot of money. They like this environment, and they're going to try to push this environment into more trading, into more desperation, into more action. So you need to be prepared for it. We're going to talk just about what's going on at the macro level first. We'll dig into the ways to trade it in the last 10 minutes. But for right now, just a reminder, the Fed repo rate activity has surged on Friday, buying about $29.4 billion in repo, also providing about $50 billion in overnight lending through the secured repo facility. Now, usually that should be about $5 billion. 50 billion is a lot of money. And the whole big debate of what people are doing right now, they're saying, or are they printing money or are they not printing money? They're putting the words printing money in quotes, and that's become the debate. And that's the stupidest thing that we could be doing right now. It doesn't matter. It doesn't matter if we call it money printing or stabilization of money flows. The only thing that matters is the outcome. Judge the financial system by its outcome. I don't care if it's QE. I don't care if it's repo buying. I don't care if it's SRF. I don't care if it's a bank lending program that they invented in the middle of the night in March of 2023. The only thing that I care about is the fact that it all leads to the same outcome, which is stability. And stability is positive for the market. Stability is positive for leverage. Stability is positive for liquidity. Stability is positive for insider buying and momentum. So when the plumbing is a mess and the leverage unwinds and it unwinds fast, they're going to inject. Are they printing money? I don't care if it's that term. There's lots of different ways to print money. It's not just QE. Printing money is in what is called the shadow system. So when they do these repo events and they do this SRF, they're creating claims, more claims in the repo system, in the shadow system. I'm not going to hang it up on this. I'm just going to point this out. That is where you create what are new forms of IOUs. And what are IOUs? Money. It's on the front of your dollar bill. A Federal Reserve note for the purposes of settling all debts, public and private. The agreements that happen in these systems are agreements and debts that are private and will be settled later. Those claims are a form of capital. Those claims lead to more speculation. Those claims lead to an expansion of the monetary system, just not the one that is in the commercial banking system. This matters. It matters because it shows that the entire financial system has changed drastically since 2008. And it's very clear that a very small percent of people actually take the time to dig into this because they're in the world going, oh, the AI trade has cooled off today. No, there is stress and volatility being driven by the repo and the SOFR rates. There is stress in the banking system, and it's evident. And it's not just end of month stuff that happened the other day. This has been going on for a month and a half. The FAZ, which is the triple bear ETF for banks, is well above its 50-day moving average. It doesn't do that unless there are some signs of stress in the banking system. There's no reason to bet against banks at that tilt unless there is something else happening. So we're keeping a very close eye on what's happening over here on the banking side. And then next, we keep a very close eye on the FNGD, which is the leveraged inverse ETN tied to debt in the FANGs. I know this is a lot. I know you're sitting here going, I just had one cup of coffee. I say, just put some whiskey in it. It'll make a lot more sense. The reality is this: when this gets above its 50-day moving average, that's where we see real stress in the leverage in the financial and broader stock market. That's where the breakdowns have happened. This is where we had the Nikkei crash. This is where we had the trade crash. We're not there yet. We're having a banking event happening right now. If it spills over into the FANG stocks, that will spill over into broader momentum. And that will create some deeper challenges for this market in the near term. AI trade stalling, sure, call it what you will, but the concentration risk is what needs to be in focus because there ain't a lot of places left to hide. If we look at the current state of affairs, you see 64% of stocks are now under their 50-day moving average. That's not good. That's not good. That is a sign of weakness. Half of stocks are under their 200-day. Now, the bulls are saying they're bullish. Okay, that's great. That just shows you where we are right now with the VIX up 5% to start the day and everything else getting beaten up, particularly the metals. Bitcoin's down, Nikkei's down, copper's down, palladium's down, leverage is down. Gold's under 4,000. Somebody said gold crashed. Somebody wrote that the other day. They said gold crashed. Gold crashed. What? What? I will take it at its 50-day moving average. It didn't crash. That's not a crash. A crash is 25, 30%. Everybody's an expert, though. That's where we are. Look, watch the flows on these names. Watch NVIDIA. Watch the FNGD. This stuff starts to break out. Breadth deterioration leads to fast rotation, which again can lead to very strong mean reversion trades, which we're going to talk about at 9:10. Sector momentum is extremely weak across the board. Yeah. It ain't good out there. And again, the big names, the NVIDIAs of the world, the Microns of the world, they're carrying the S&P 500 higher. But you look down in that S&P 5, you look down in that Russell 2000, you take the number of stocks breaking out versus breaking down in industrial, it's 2-to-1. It's negative. It's ugly. The financials are red. Healthcare and energy are holding up, but healthcare was trickling yesterday, and I don't know how much longer energy can hold up. So we're going to be in an environment, and if all 11 of our sectors are red, you can damn well bet everything else is red. And this market is now ready for a potential big move to the downside if it cannot hold its 20 and its 50-day moving averages in the S&P 500 and the NASDAQ. Large cap stocks are still leading. Small caps and cyclicals are losing steam. It really is a bad time. This has completely and totally taken a completely different turn of events. With the government shutdown and the lack of data, that's obviously important. But on top of this, not cutting interest rates, okay? Not cutting interest rates, but instead focusing on the plumbing of the leverage in the financial system, not focusing on the real economy, the Fed, focusing on the shadow one. That's what they are doing right now. They're not cutting interest rates because they are very well aware that inflation will rear its head. Cutting interest rates could very well create a situation where the CPI goes back to 4%. So what do? They turn their heads to the repo market and to the leverage market, and they shore that up. And what happens? The inflation and the debasement in our currency doesn't show up in food and fruits and vegetables. It shows up in equity prices. It shows up in housing. It shows up in real estate. It shows up in land. It shows up in stocks. And it shows up in bonds. That is exactly the point. Who do they work for? These repo injections are not for you. They are for the banking system and for the leverage hedge funds that own the debt. They are keeping and protecting that situation at best as they can. And they're going to try at a later time to cut interest rates. And now the real story begins. It's runner time. How do you plan on preparing for the big crash? We'll talk about that. Let's start with the obvious. So we've got the runner. You're going to see a lot of consumer cyclical names on this because that's where the problems are. So, well, I'm doing volume weighted average price stuff over on Thinkorswim, so I'm going to keep this on the old FinViz for now. Look, somebody's going to buy this company at some point. McDonald's should probably just do it, get it over with. Shake Shack. Shake Shack. All right. It's on the breakout line largely because of these moves. We're looking at the 1 hour and the 30. And we were doing better before we measured this. This has been moving down a little bit today. Well, good news. This is great. This might actually become short. This might actually become a straddle instead at the 92 level. We'll have to take a look at what's going on with the implied volatility range. I'm going to go to the 3 minute, 4 minute, 15 minute. There we go. 15. This is short. So 94, sell the 90. Ooh, wow. This is down that bad. Yikes. Yeah, probably $90. Looking for this to move back to oversold. Shack, and then when you get to oversold, turn right back around and buy the dip. Oversold, lead here. Oversold, run. Overbought, sell. Overbought, sell off. So once again, Shack, don't view it as a breakout. Move it out. Is that? I don't know what is going on. Weird. All right. Anyway, yeah, this went the wrong way. This one went bad. Lending Tree, you're still around. Everything's down today. Everything's getting beaten up today. So, like, I'm not touching the financials right now. It's very hard right now to keep any of this optimistic. So we need to move these breakouts into the breakdowns. Shack and Tree, no, it's not happening. What's even breaking out? Nothing. MAGA looks good. This actually looks like a better move to the downside. MGA. All right. We need to spend a little bit more time on some of this stuff because the breakout's just ugly. Scratch the whole breakout list and move all of them into the breakdown list. Anything that's cyclical and financials are not going long today. We need to focus on energy if we're going to do that. Let's go to the short side. Keurig Dr. Pepper. You are. Ugh. This is an awesome chart in that the fact that the MACD is just completely rolled over. So let's pull the trade out of that. Screeners were a little off today on the upside. That happens. I'm going to pull my other chart, other screener up in a minute. KDP. Come on, Keurig. Do anything. What a. Okay. So, downside, November. Ooh. Wow, these things are so wide. Damn it. KDP is way too wide. Can you short Coke? Yeah, do that. Same animal. I'd rather short Coca-Cola than short Keurig anyway, largely because it's going to be way more liquid option chain. November 21st, 69, put right to 66. All right. $1.16. KO. Why KO? It's lower highs, lower lows. Tracking on that hourly. Continue weakness on the 30. This is in a negative channel. Lower highs, lower lows. This might retest 68.53. I'm going to roll this thing lower. KO. Pretty simple trade. You're putting up 116 to make 184 into next Friday. 40% probability of profit. How do I increase that probability of profit? I buy the 70 and I sell the 67. And that raises the probability of profit to 49% and an 85% return. So buying the 69, selling the 66, or buying the 70 and the 67, selling the 67. It depends on what type of return you're willing to do. KO is way more liquid. I like that. KO, November 21. So buy. Right. On top of that, EL, this keeps popping up. Estee Lauder, very strong momentum stock. This is really got to continue to break down, but everything right now looks brutal on this for consumer defensive. Unprofitable company. I did not know that. That's not good. This is where we start to really see the cracks in the economy starting to form. And it's not like they're not already there, but these elements, like it's Estee Lauder, it's the MLM world, right? Of cosmetics as well. You know, like, is Herbalife still around? These are the names that are going to see continued pressure because that model relies upon not just Ponzi economics, but really the ability to take part in that nonsense. EL. I like EL. Let's do that. What can we do with it? This thing's just loading up a joy today. All right, I'm going to keep going with this. AEO is also on this. This is a pretty wide spread, unfortunately, on EL. But you get out into the 93 and you write 88. You got earnings coming up. Shoot. But I will say, if you're brave enough, the 93 and the 88 for the 21st, 188 to make 312. If this thing breaks down to say 88, where are we here? 91. Yeah, if this can get down to somewhere like 91 in the next couple of days, you'd be up 25%. If you're buying the 93 and writing the 88, pretty good. But you need this thing to really break down. This isn't that's not reflecting, right? That's why. 91. All right. Momentum in volatility, natural gas, USD. Breaking out, breaking down, none. Rotating, none. Yeah, it's that type of day. I do want to point that out. AEO. Okay. I did just buy the 16 on the AEO 2 weeks and just ride it. It's more of a lottery ticket than anything else. But when this breaks down, it breaks down fast. And the cyclicals are under an incredible amount of pressure. So long put, AEO. I'm just going to go for this one. November 21st. See if I can get the 16 for 60 cents. 37% probability of profit, $60. You get a move down to at 14 level we were just at. That would give you a $200 return. Keep a stop on that trade back at around 1644. $16 put for American Eagle Outfitters. 2 weeks out. Yeah. Ride the lightning. Go for it. All right. So here's the main event. So my dogs sit here and just stare at me, and they hear vacuum cleaners on the other side of the door. We talked a little bit about this, right? We talked about the idea of trading momentum based on equities that have very specific characteristics. Now, NVIDIA, again, is the market. It's the single largest company in the equity system. It has done this, right? 10x since 2023. And again, since the bottom of the liquidity market, gone from $13 to 202. Here's the thing. The stocks that continue to showcase this much momentum and showcase this much liquidity are the stocks that have these relatively sizable pullbacks. And they'll have the pullbacks. Sometimes it'll just be profit taking. Sometimes it'll be headline driven. But the reality is they continue to bounce off these key support levels, 8, 20, 50. And that's what you're really looking for. So as we are seeing a little bit of pressure on NVIDIA today, there are two places that you have to keep an eye on. The first is coming all the way down to your 1 minute volume weighted average price. Okay. This is Thinkorswim. And we figured it out. We know what we're doing. Allegedly. We had a move this morning, 5 o'clock in the morning. There's your low. Let's go to our 5-day chart. Okay. What we're looking for in the actual day market is a move down toward the third or fourth standard deviation. These lines, this white line is your 1 minute volume weighted average price. These are the first standard deviations of price, second standard deviations of price, and third standard deviations of price. We go back and we listen to Stanley Druckenmiller from 2018 in a Real Vision interview in which he noted this is a guy who made 30% a year for 30 years trading trends. And he argued at the time, it's broken. The markets are broken. And they're broken because what is happening is that these algorithms are stepping in when we hit this third or fourth standard deviation line, and they're bidding back in. If you're trying to short this market, it ain't going to be going to help you to try to buy puts down here. And the reason for that is because this is the institutional line. This is where the positioning is done. Down here is where there's panic selling, but there's also institutional and algorithmic buying that will pull this up. If you're in a short-term trade trying to short NVIDIA from 204 and you buy a put, it's going to expire either Thursday, or Friday, or maybe out a couple of weeks. Well, suddenly just a couple of minutes, maybe an hour, maybe 2 hours can basically stop you out. So it's optimal to be trying to make those short trades close to this line, or even better, up here, right? Up here where there's more room for the downside. But the names that you have to be trading and focused on in this environment are the ones that are near all those all-time highs that have these significant moves up and down, because there's profit taking along the way. There's a lot of trading. There's a lot of panic, but the long-term trend remains intact. Also, these are the stocks that break down very quickly when you get a big momentum event. So what are the stocks? Well, in addition to volume weighted average price, I want you to be paying attention to a couple of other key things. First off, the 8, the 20, and the 50-day EMA. These are longer term setups for really if our momentum is negative and these stocks start to break under these lines, that's where you can be aggressive with shorts. But really for the weekly type moves, this becomes the key swing level for me, 15-minute chart. And what I'm going to be looking for is the adjusted 8-minute, which is roughly 15 times 80 is 120 minutes, 2 hours against the 5-hour chart. At the 20, I'm looking for negative crossovers and an opportunity to short. And if it comes back above these lines, I'm out of the trade, but I should be profitable because the momentum is showing me in these lines the way that the stock is moving. In addition to this, you see that when it crosses back over, it's creating some short-term moves as well. This is the chop that we talk about. And now you see a range-bound stock between 202 and 212 over the last couple of days. There's not a lot of things you can do with that unless you bring it in even further. And that's where the 3 and the 8, the 3-minute chart becomes valuable. Because when that 8 adjusted the 24-minute, again, all of these are adjusted. So an EMA 8 chart is 3 minutes times 8, 24 minutes, 24 and 60. Look at what happens when we get these crossovers. You'll get presented this during the day, and if you stay in the money and you look for Friday's put and you just trade that and use the leverage, so long as this doesn't come back above this line. Remember, you're shorting as this is crossing over. And what do? You try to follow momentum down on the adjusted orange line. If this comes back up and hits the red line and moves above it, you exit the trade because this is going to roll back up. It's going to follow it. Key thing here is this is your trend for the trade. This is your exit for the trade. And that way you know exactly where you are and what you're doing at all times. And the thing about this, it's going to come back the other way too. You'll have these moves like we had on Monday coming out of oversold. In some places coming out of deviation bands, oversold. And then moving higher and higher and higher. And $3 on NVDA, a short-dated option, can make a lot of money. It can turn 5, 10, 15 minutes of your time into a 20% gain. Your stocks for today on this are NVIDIA, Micron, ARC Innovation. We had a great trade on this on Friday. Got a 68% return in about 20 minutes. This has bounced around. It will bounce around. Follow the momentum. Keep tight stops. This is how you're going to trade those ranges. And those opportunities will emerge during the day. You have to just be patient. Yesterday, I moved from 68 up to about a 70-cent move. It doesn't seem that big, but if you're trading in the money, it will pay off very, very well. In addition to that, Amazon. I know I'm giving you the names that you already know. Well, guess what? This is where the liquidity is. This is where you can get in and out of a trade relatively quickly. Amazon didn't perform anything the other day, but it sure delivered last week a couple of times. On top of that, JP Morgan. The volume is there. The focus is there. The banks are under stress. JP Morgan is the top dog in this space. The regionals are under pressure. And the big banks are under pressure too. And if JP Morgan starts to sell off, we know there's something wrong. We know that it is bigger than just the regionals. We know it's starting to impact other places. It's starting to impact the balance sheets of companies like Goldman and JP Morgan that are originators in the private credit sectors. Let's pay attention to this because this is what can drag a sector down very quickly. Caterpillar. This absolutely ran. It has had an incredible run from around 275 up to nearly 600 since the Liberation Day fiasco. But now, again, this market has overextended. People will say that this is about valuations. I'm telling you, this is about liquidity and plumbing and leverage. And if this unwinds, it will unwind quick. And these are going to be the stocks that will take it on the teeth the hardest because they have been doing the heaviest lifting for the last couple of months. All right, everybody, it is 9:22. That means Don is coming up. Don's coming up. All right, I'm back here at 1 o'clock for NVIDIA Masterclass. On top of that, we'll be talking about trades staying short the KRE. A lot of weakness in Bitcoin. That is a pure proxy of what is happening in global liquidity markets right now. Don's going to be taking over in a little bit. Give him 8 minutes. He's going to throw some music on. I will be back at 3 o'clock to close out the trading day, and we will talk about some of these names, and I'll walk you through some of the charts as we traded accordingly. Have a great day. Talk to you soon.